Good afternoon, sir.
Good afternoon. Shall we start?
Yeah, good afternoon, sir.
Okay. Okay. Today, this module three types of advances, different types of advances. We already discussed, I think, lease finance and hire purchase finance. So today we are going to discuss another two more facilities where uh, large corporates are handling. It's called consortium or syndicate loan. What is syndicate loan? When to get syndicate loans? What is the process of syndicate loans? What are the types of syndicate loans? We're going to discuss today. What is syndicate loan? Is a loan as a syndicated bank facility. It's a loan offered by a group of lenders, referred as a syndicate, that work together to provide funds for a single borrower. One borrower, number of lenders. Normally in our system we get number of borrowers, one single lender. Here, number of banks get together granting a facility for a one customer, borrower. It's called a syndicate loan. Right? Now this normally this type of facilities not very commonly used, where rarely comes, depending on the uh, large volume of transactions, large volume of a loan facility, in the syndicate loan is we consider, right? Of a group of lenders, a number of banks get together, granting a facility to one borrower. The borrower could be a corporation, a large project, or a sovereignty, such as a government. The loan can be involve a fixed amount of funds, a credit line, or combination of the two. Funds fixed amount or credit line for a separate lending organization. We are giving funds like ADB or World Bank funds. With combination with external funds and internal funds, it can be a combination or individual. Okay. Syndicate loan, the process of involving several different lenders in providing various portions of a loan. Loan syndication most often occurs in situations where a borrower requires a large sum of capital that may either to be too much for a single lender to provide or may be outside the scope of lenders' risk exposure levels. Thus, multiple lenders work together, provide the borrower with the capital needed at an appropriate rate agreed upon by all lenders. Now, what is syndicate loan? Why we are going for syndicate loan? What the purpose of syndicate loan? Basically, syndicate loans is a normal credit facility where the amount a large sum, borrower requires a very large amount. It can be large corporate or large project, need a large amount of funds. Though a single lender, a bank or a lender cannot take that a risk, high risk exposure. Lend to one with high risk exposure, therefore the risk can be distributed among the other lenders by going for a syndication. Right? Not taking a large amount, because if anything happens, defaults, the entire bank may collapse. It's one facility. Therefore, normally banks not going for such type of exposure risks. Second one is there are certain limitation of lending limitations. The central bank directives, guidelines, maximum amount could be granted for a bank is limited for one particular customer, single customer, right? So the capital amount is 55%. More than that, you cannot grant a facility for one customer. So therefore, if any customer needed a large sum of rupees, say 1 billion or 2 billion facility, that may not be possible for one bank to take it, because that you call single lender or single borrower exposure limits are there with the central bank. Time to time they change the single limits depending on the risk situation in the lending and the loan expansion, controls of the loan expansion by the central bank. So these two reasons, the banks has to go for a syndicate facility. Normally, if the facility is too large, banks are considered to go for a syndication. Get other banks also involved together to grant a facility. Right. How it works? When a project is unusually large or complex, it may exceed the capacity of a single lender. Capacity, lending capacity, or risk level. For example, the amount of loan may be too large, the risk too high. The collateral may be in different locations, or the users of capital may require special expertise to understand and manage it. In these cases, a financial institution may bring other lenders into the deal. Now, there are two extraordinary cases here. One is capital may require a special expertise to understand and manage it. Customers' normal requirements, we can understand credit. But whenever we go for a special projects, large projects, which is needed special expertise, for example, industry, large corporations, plus industrial projects, single bank may not be able to handle that because their expertise is taking a small bank. The expertise in handling those type of large businesses is a risk. Therefore, the option is going for a syndication loan. The other one is if the customer has to go for number of banks for their requirement. The requirement is very large. If a single bank cannot offer that one, the customer has to go to number of banks individually and apply for individual separate loan limits. It's going to be a complex situation. Number one is the customer has to get into contract, loan agreements with the number of banks, number of loan agreements. Second problem is with the collateral. If the collateral cannot be, so if a customer is offering one large, the entire project as a collateral, that cannot be divided among the banks. Right? On the other hand, banks may not go for, if you take, for example, property mortgage, always banks are going for primary mortgage. Banks are not willing to go for secondary mortgage or tertiary mortgage. So that you go for secondary mortgage or tertiary mortgage, right? In the case of a recovery, first preference goes to the primary mortgage. Therefore, secondary mortgages and tertiary mortgages getting, if anything, lift over only. So there's a high risk. Therefore, normally banks are not going for this secondary mortgage or tertiary mortgages. Therefore, the option is going for a syndication. Okay. In syndication, documentation is very simple. It comes to that time. So syndicate loans arise when project requires too large a loan for a single lender. Large facility asking for a customer. It's a large project. Or when a project needs specialized lender with special asset class, specialized performance levels. Syndicate is a loan on a project allows lenders to spread the risk and take part in financial opportunities that may be too large for their individual capital base. depending on the bank's capital base, we have to take the risk depending on the capital base. Because our capital, most of the bank's capitals are limited. Therefore, the bank cannot go beyond certain limits of exposure. Exposure limits are limited. So, in it, exposure is exceeded, then we have to go for a syndication. Secondly, risk sharing. Risk sharing is the most important part. If it is large projects, the risk also very large. Therefore, it has to be managed with the opportunity, given the opportunity to other lenders or the bankers to get involved with the lending project and spread the risk and contribute by that bank for that customer's loan capital, what you call financial need. Interest rate on this type of loan can be fixed or floating based on benchmark rates such as London Interbank offered rate, or Sri Lanka we are offering LIBOR plus, or Sri Lanka we go for benchmark rating is what do you call weighted average lending rate, WLR rate. In Sri Lanka we apply WLR or weighted average lending rate. So based on that, interest rate can be decided. Normally, interest rates are fixed, fixed for the entire loan. So all the lenders will agree for that interest rate, offering at one single rate. Different now. For example, if the customer go for different banks for taking loans, so customers will pay the interest rates are differs from one bank to another. When it comes to syndicate loan, it will be flat. As one interest rate will be applicable for entire loan. So all the banks will agree for that interest rate. Two or more banks, syndicate lenders, contract with the borrower to provide credit on the common terms and conditions governed by a common document. Now here, the document will be one document. Although the number of banks involved in, two or more banks are involved in the lending, the contract between the borrower and the bank will be one loan agreement. Right? Provide credit on the common terms and conditions. The terms and conditions are common to common customers. So therefore, there's no difficult for a customer because all terms and conditions are laid down as same. But the lending, the what you call contribution to the loan will be done by the different banks. And condition governed by a common document. Even if you go for taking a mortgage, which is property mortgage, if you go for a property mortgage, there again one common mortgage bond will be taken by the lenders. All the lenders get together, one document will be taken. In the case of syndicate loans, the mortgage bond will be concurrent mortgage bond. Concurrent mortgage bond will be taken. That will be all the banks are get similar rights in the mortgage bond. So no bank is getting a priority. All the banks are getting similar title, similar priority in the concurrent mortgage bond. Customer has to sign only one document, so stamp duty will be paid only once, right? So therefore, there are a lot of advantages going for these syndicate loans, going for large projects, right? Then multi-bank transaction and each bank acting severally. So although banks are commonly document signed, one document, one loan agreement, one collateral agreement, everything is fine. But the banks have their own way of to take that severely, separately can act. The independence is not blocked by that. That means any bank want to get out from the syndication, that bank can do the out the syndication by either other banks will take over the share or another bank comes and take over the share, that share. That in other words, that bank can sell its investment portfolio to another bank. So this is one of the advantages the syndicate loans. Although common documentation, banks have ultimately the individual right to take legal action against the borrower. Okay. Now, for example, if the terms and conditions are violated by the borrower, individually bank can take action, not collectively. Although number of banks got together in undocumented grant facility, that doesn't mean if one bank want to take action against a customer, that is allowed. That can be done. So they have his whatever proportionate contribution, that bank can file action against the borrower under the syndicate loan system. So these are the advantages in syndicate loans. Interest usually accrues at a variable or floating rate and is reset periodically at agreed intervals, usually borrower's choice. Normally, the interest rate will be decided by all the banks get together, they decide the interest rate, and that rate will be applicable for entire loan. So customer has to pay that interest, and interest, whatever interest paid will be shared by the participating banks. Normally, for a medium term, maturity at 3 to 10 years, facility loans, syndicate loans for mostly for long terms, 7 to 10 years. Normally, it's long term because it's a property mortgage. Banks participate in common terms and conditions, but not necessarily equal amounts. Right? Common terms and conditions are common to all the banks, participating banks, but banks can be contributed in equal amounts. The amount, according to their capacity, they can contribute. Okay. Objectives of syndicate loans are, the main goal of syndicated lending is to spread the risk of a borrower default across the multiple lenders such as banks or institutional investors such as pension funds and hedge funds. Now, normally, not only the banks, any financial institution or a financial investment organization can contribute for a syndicate loan. Okay, not only a bank. Lender may be a bank or a financial institution or any other funds. For example, we say the government is going to work out a large project, some road construction or some large project. So they want to borrow from a bank, that money to be borrowed from the bank. So one single bank cannot take that risk. So the bank will offer that to the other organization, open it up. So not only the bank, even funds like pension fund, provident funds, ETF funds, they also can invest their money in syndicate loans. Not necessarily to be a banker, but organizing one bank, collecting funds for the lending institutions. So this is one of the technique where other fund owners, pension funds, ETF, employees trust fund, employees provident fund, and sometimes you may find in Sri Lanka we have got not that much of big housing funds, but other countries you get housing society funds. The funds are collected for a specific person, will be invested in profit earning organization. So not necessarily to be a bank, right? Because syndicate loans tend to be much larger than standard bank loans, the risk of even one borrower defaulting could triple the single lender. This is what we discussed earlier also. Because of sometimes you may see exposure is not going beyond 50% of the bank total capital. If it's gone beyond that, if one loan defaulted, the entire bank will collapse. So that will be a risk chain of impact on the one bank is collapsed. See, all other banks facing for risk of collapsing because it has an impact of a chain. Chain impact is there. The bank collapse. Because all the banks and financial institutions conduct or carry out their business on the trust of the depositors. Trust. So the moment one bank defaults and loses the trust, the risk will spread to other banks also. Therefore, it is banks, all financial institutions try to avoid such type of risk. So syndicate loans will be one of the answers for this type of risk. Syndicate loans are also used in the leverage buyout community to fund large corporate takeovers with preliminary debt funding. This is normally in Sri Lanka, we don't find such buyouts community. Large corporate takeovers, for example, recently they have had something like that. Now, let's say, okay, one investor want to buy a large corporate, right? Now, for example, Cargills, they bought the Coca-Cola. They bought the Coca-Cola company. To buy out piece, they buy entire company. To buy this company, sometimes the funds, to pay the immediate funds, right, to the Pure Beverages Limited earlier, to pay out debt. Sometimes Cargills may ask for a loan. So the amount is loan is very high. One bank may not be able to take up that risk. So Cargills, who bought this Cargills Coca-Cola, has to make offer, whereas their bankers, for example, their banker will say, for example, is Standard Chartered Bank. So Standard Chartered Bank invite other banks to make contribution, all the participate in providing the funds. Right? So then, if the project is viable, most of the banks or financial institutions may come forward for funding that project. Depending on the viability of and profitability of the project, participating lenders will take part in participating for that project. Likewise, large buyouts. You may find a large amount of in corporate market. You find a lot of this type of transactions are going on. Right? For example, if the government-owned organization, right? One of the government-owned organization want to sell their shares. It happened some time back. Take in the case of Gallaya Sugar, right? Singurana Sugar Corporation, right? The sugar companies put in the market for the private sector. The private sector, LOLC, another company, bought the 49% of the shares of that sugar industry. Right? The sugar company. So to buy out that sugar company, sometimes they may ask for a facility from other organizations because the investment is high risk. Okay, so used in the large buyout, mostly it is project financing in the large projects. Also in the buyouts, selling or buying of large businesses. Also, the syndicate loans are taken, given by the lenders. Typically, in cases of syndicate loans, there's a lead bank or underwriter of a bank loan, known as an arranger, the agent or lead lender. Now, normally, if the customer is for a bank, a customer of a bank, right, large corporate, want a large facility to start a large project. Large facility needed for a large project. So what will do that bank, particular bank, if their capacity is not, exposure capacity not sufficient, they play a role of a lead bank, lead bank, and invite other banks or financial institutions to participate for the syndication. So the role of the lead bank is very important to understand. The lead bank is a bank which will be coordinating with the borrower and the participating banks. Lead bank will be the managing the entire loan facility on behalf of the participating banks. Lead bank will do the documentation, collection, recovery, everything done by lead bank. They play a leadership role. In underwriting is a different arrangement. We'll come to that later. But this is underwriter. This lender may put up a proportionally bigger share of a loan, or it may be perform duties such as dispersing cash flows among other syndicate members and administrative tasks. So basically, sometimes the lender who is going to take the leading role sometimes may take a larger portfolio. Say 100 billion project. The lead bank may take up to the 50% of that 50 billion, and balance 50 billion can be given for the other banks can be contributed for that balance 50 billion. Okay. So lead bank will be playing the role I told earlier, and the documentation, all the administration work, that is arranging the loan, documentation, registration part of it, and the loan will be maintained at lead bank, and lead bank will collect the what you call repayments. Right? Repayments will be collected and paid back to the participating bank with the interest and their loan, according to their agreements. Normally, to go for a syndicate, the syndicate, to apply a syndicate loan, the borrower should have a high rating. Right? Now, Sri Lanka Standard and Poor, these are the international standards. In Sri Lanka also you got Fitch rating is the most common in Sri Lanka. Standard and Poor and Moody's are some of the they call large rating agencies. So normally they are given a rating in a grade wise. Risk-free A, AAA is a risk-free area. Standard and Poor normally. Even Fitch ratings are same. The investment grade is BBB minus to AA plus. You would get possibility of investment. When the B plus and up to B minus, double B plus to B minus are non-investment grade. So these companies are high risk category where the ratings are less than B plus. They are in the non-investment grade. These companies are treated as high risk grade. Then triple C and less are distress companies which are highly risk of default. Then defaulter facilities if any company has given D on the S&P, that is Standard Poor rating, or Moody's rating C, is considered as defaulted. That is unable to pay their debts. So this rating is very important. With that standard, the rating standard, the company's financial viability is counted. So normally for syndicate loans, risk-free either AAA or up to AA, AA plus, AA, consider for investment, right? So for syndicate loans, investment, bank participation will accept. Less than that, normally there's a high risk. Therefore, the companies having this type of rating, normally, even for normal loans, banks are not considering because the risk is very high. Right. What are fund requirement? Short-term finance, where the funds are required up to period of 1 year. Such finance is required to meet the working capital requirement or special seasonal needs. So syndicate loan can go for a short-term facility also to meet the working capital requirement. Short-term finance up to 1 year. You have to meet working capital requirements or special seasonal needs. Right? So their project is large amount. Amount is very large anyway. Working requirement also a large amount. Such investment will be revolving sometime. Normally working capital financing are revolving facilities that given for 1 year and revolve thereafter, depending on the operational cycle. Then medium-term finance, where the funds are needed for a period of 1 to 5 years. Such finance is needed to provide funds for permanent working capital, expansion or replacement of asset, etc. These are available from SFCs, finance companies, commercial bank, and all in India, that's called Indian financial institution through special schemes. They have Indian scenario. This is right. It can be applied. So medium-term finance is 1 to 5 years. Normally 1 to 5 years for permanent working capital. What are permanent working capital? Permanent working capital. We discuss this all in the working capital finance class. Yeah. Permanent working capital is working capital needed for, it is fixed. Working capital is revolving, but it will be in a certain limit, it is fixed. There are two type of requirement. One is for permanent working capital needed, debtors and inventory. Debtors and inventory, the funds are blocked. The funds of the customer blocked. Therefore, it's called as permanent working capital. Right? So normally, short-term term loans are finance is required for short-term operating working capital. So the working capital will be revolving short-term, right? Needed for one cycle, then it will be revolving number of times for a year. That is called operating working capital. Permanent working capital, normally for 1 to 3 years or 1 to 5 years is granted. Also, medium-term finance is given for business customers for the purpose of financing the what you call fixed assets such as machinery, vehicles, furniture and fittings. Upgrading these areas. The facilities can be given maximum up to 5 years, medium term. Normally we give for 3 years. For machinery, normally we give for 3 years. Going beyond 3 years is a risk. Therefore, it's called normally medium-term loan. In long-term finance, where the funds are needed for a period of more than 5 years. The long-term facilities are needed for infrastructure development, construction, like that is for more than 5 years, 5 to 10 years or 15 years. So if you look at this we call this as a structuring. So any customer's need, finance need, we can identify in the 3 stages: short-term finance need, medium-term finance need, long-term finance need. When the quantum is small, we are giving normal lending from the banks under this category. When it is going to large, same principle, same thing will be applied. Where the amount is large, therefore loan is participated by other banks to share the risk. That's a difference. So fund requirements are need-based finance, short-term, medium-term, and long-term. The purpose of short-term working capital is revolving working capital. Medium-term working capital for replacement of assets, or purchase of assets, not fixed assets, not permanent, not what you call land and building and other fixed assets. It is asset requirement, non-current assets. Otherwise, the long-term facilities are needed for construction work, purchase of lands and buildings, large permanent machinery. Those are comes under long-term finance. Right. Let us look at the structure, how the syndicate loans are operated. Now, borrower, customer, requires certain amount of money, a large amount of money. So he make the application to his bank. Just make this application, loan request, he offered to his bank. Then that bank or lead manager, if you see that the request of the customer cannot be fulfilled due to heavy exposure, lead bank will try to get funds from the other institutions. So lead bank will publish call for to participate for that amount by other banks. So there can be other banks like Bank A, Bank B, Bank C. We need to negotiate to contribute for the lead bank's request to grant the facility. This is called syndicate loan. It's called syndicate loan. So borrower will be directly dealing with the lead bank, and no transaction between the participating bank directly. It is through the lead bank only, all the transactions are movements are moving on upward as well as downward. Now that's one institution of what is called underwriter. The borrower requests a certain amount. The lead bank may not in a position to entertain that facility by themselves. They call for participation by other banks. Now banks are offered their participation, and if the lead bank finds that is still not fulfill the borrower's credit requirement. Now, for example, it's 100 million rupees worth of borrower wanted. That 100 million rupees lead bank cannot be granted. So lead bank will call invitation from the other participating banks participating in that. So bank A may agree to grant 250 million. Bank B may accept to grant 100 million. Bank C may agree to give another 100 million. Altogether, 450 million collected. Balance 550 million not fulfilled. Therefore, what will happen? Borrower's request or requirement cannot be fulfilled. In such instances, the borrower will agree to make an arrangement with an underwriter. Underwriter is another bank. Sometimes maybe the lead bank or another outside bank or outside organization. to underwrite this lending transaction. Now, for example, the lending part is a small amount, will take a 50 million, another 150 million shortfall. All four banks are agreed to take certain amount. There are different of 150 million. Right? So the underwriter will provide that amount at the agreed rate, sometime maybe different rate with this one. Underwriter will provide the funds to fulfill that to the lead bank. Right? Sometimes lead bank may be work as underwriting bank or any outsider comes as underwriter bank. So underwriter bank will fulfill the requirement of the shortfall. If there's no underwriter or if underwriter withdraws their right, then the entire loan proposal may be not accepted or collapse. Right? No loan proposal may not be fulfilled. Either borrower has to agree for the lesser amount or cancel the entire transaction. Whatever participating bank agree to do to the lead bank, customer may have to agree for it or they'll leave it out. So this is simply how the syndicate loans operates. In Sri Lanka, the recent past, we have not come across a large this type of projects. But some time back we had, I think I can remember, there are a lot of, were instances in 1980s when our economy was open, economy was introduced, and business was expanding very rapidly. Financial needs were very large. Then therefore, most of the companies got asked for large facilities where the banks could not be fulfilled. Thereby, the lead banks have to arrange for syndicate loans. That is not seen in the recent past because our financial markets are not developed, or can call us underdeveloped. We don't have a large financial market in Sri Lanka. Only share market and call money market. Therefore, large capital markets are not operating because there's no large businesses are not coming to operations in the recent past, and they are not asking money from the customers for contribute for their shareholding. So business is lacking for the last couple of years. Maybe if this position change in Sri Lanka also, sometimes we may see that need for syndicate loans and other corporate type of facilities may be increased in the future if our economy and the financial markets are established and the business is moving forward. Now, of course, there's a lack, not only for the COVID, but before that it started. Okay, so let's go to the details. What is the lead manager, role of the lead manager, how the lead manager operates. The bank that awarded the mandate by the prospective borrower is called lead bank or the lead manager. The bank that awarded the mandate by the prospective borrower is called lead manager or the lead bank. For example, I gave the example earlier. This is Cargill's. So Cargill's having accounts with the Standard Chartered banks. So Standard Chartered Bank is the bank which is awarded the mandate. Right? That's called playing a role of a lead manager. Then it is responsible for placing the syndicate loan with other banks. Then whenever the amount is large, the syndicate loans that is offered to other banks by the lead manager. It ensures that the syndicate loan is fully subpriced. Lead manager will see that entire syndicate loan is fully subpriced. Otherwise, what will happen? I told earlier. Either the syndicate loan has to be cancelled or the borrower has to accept what is the syndicated amount. Right? So that is even the syndicate loan participation, the participating organization in the institution will carefully analyze the risk and the future prospects of this project, the proposal. Then only they come forward for invest their money in with the lead bank. The lead bank have two types of income. One is arrangement fee. That is intermediary. Lead manager will be arranging the entire proposal, that is calling for participation, preparing documents, executing the documents, monitoring of the performance of the loan. Loan will be managed, and whatever recoveries have been given for the participating banks as their share, that all this has to be done by the lead manager. Then the underwriting bank or the underwriting organization's bank commits to supply the funds to the borrower. If in case of a shortfall, if it's not fulfilled completely, right? So the underwriter will take over the position, no supplying of funds to the borrower. Now, the underwriting, very common we have heard of in the share issues. That is large share issues where the shares were issued. What is IPO? After the IPO, initial public offer, there's full complete contribution to the capital, right? Then the share issue will be success. Sometimes you may find it will not fully subscribe. It may not fully subscribe. For example, recently, the Sampas Bank put a share issue to the market, right? But it was undersubscribed. It was undersubscribed. There's no bias to buy shares of Sampas Bank. It happened recently. So when before the IPO, initial public offer, underwriter has to be organized. Some bank may come forward and they'll take the underwriting. If that contribution is not subscribed, right? The participating banks have not subscribed fully to the requirement of the credit. That the difference between the amount received and the loan offered will be given by a underwriting bank. The underwriting bank will charge commission for that, for their risk, and their investment charges. Then separate charges will be taken. So what underwriting bank, what will they do? When the business established and running after some time smoothly, the underwriting bank may risk their shares, they sell their shares to the other underwriters or any outsider. Okay. Now, role of underwriting is coming in share market, the share prices. When the shares are put in the market, if not fully subscribed, underwriter will take over There can be instances like what happened in the Sampat Bank case, because underwriters may withdraw from the underwriting. Then the entire share issue will be collapsed. Similarly, in the syndicate loan also. Normally, underwriting role is carried out by mostly the merchant banks, not the commercial banks. Mostly merchant banks will carry out the underwriting bank's role. In the case of not fully contributed, the difference will be contributed by the underwriting bank. Bank that commits to supply funds to the borrower. Okay, banks have a commitment to supply funds to the borrower. That is the whatever requirement of the borrower will be fulfilled. The difference will be fulfilled by the underwriter. So the main portion will be given by the participating banks. The gap will be fulfilled by the underwriting bank. If necessary, from its own resources, if loan is not fully subscribed. If the loan is not fully subscribed, underwriting bank will use their own funds to underwrite the issue of the syndicate. Right? What are the factors for underwriting bank facing for a risk? Why participating banks may not accept the full amount or contribute full amount by the other banks? There are a number of reasons. One the main reason is a risk factor. They consider twice, they think about twice why the participating bank has not contributed fully, supplied fully for this fund. There can be a specific risk, very uncommon. We not looked in by the lending institutions. Right? Number one. Second one, loan may not fully subscribe, then underwriter will take over the rest of it. Not all loans are underwritten. If there's a confidence that the entire loan can be participating banks can be found for contribute for the full loan, not necessarily go for underwriting bank. So the moment it goes for underwriting bank, underwriting commission has to be paid. Okay. The third organization is a participating bank. The bank that participates in the syndication by lending a portion of the total loan requirement. Lending should be lending, right? Syndication by lending a portion of total loan required. For example, say 100 million, 50 million, 25 million, 10 million, likewise, each bank, depending on their capacity, they contribute. That's called syndication. So, participating in two types of income. That is, interest from the participation loan, the given loan given interest, and participating fee. The commission is paid separately for their participation. So, any bank which try to do the participation, they are having two types of income, interest income and participation fees. The risk for the participating banks are normal credit risk. Right? What is a credit risk? When you're granting a facility to a borrower, there's a risk, always there's a risk. So the risk has to be evaluated, processed, assessed before participating bank agree to participate. Whether return for the risk is sufficient. Participating bank always have to look into whether the return from that participating on the lending with the risk and the benefit are matched. Right? So normal credit risk. Participating bank may be lead to a passive approval and complacency when the high profile bank can be go wrong. Sometimes small banks, when it comes for participation, they may not evaluate the project individually or what you call severely. Because a large bank, large corporate, large bank is is the lead bank. So the complacency is one of the weaknesses in most of the instances. Taking it to grant. Complacency means taking to grant that when many high profile banks cannot go wrong. Other bank, local bank, because they have done their homework carefully, therefore, that complacency, the other risk. Then the funding risk, mismatch for funds of inflows and outflows. Always the risk, the funding risk is very important. That means, what is the funding risk? Mismatch of funds, inflows and outflows. All the banks or finance institutions carefully take off this risk factor, funding risk. They can fund as loans or lending based on their inflows, their sources of funds. If a bank, even you're participating or not, granting a facilities to the customers without paying attention to the sources of funds, inflow funds, then that bank will be facing severe difficulties in the future. That means the funding has to be matched with the sources of funds, deposits. If the organization go for long-term finance, 5 to 10 years, using the savings account balance and the current account balance, that is payable on demand. It is a mismatch. So the risk, any moment to repay the depositors, risk can be arise. So the funding risk is very important to take into consideration. Although participating in the syndication get a high return they'll get it, right? Without any difficulty, without any effort, the participating get income. No need for advertising, no promotional activities, no effort of doing any activity to improve their loans. No, everything freely coming in. So therefore, most of the time, banks may go for the participation, but on the other hand, there's a risk. Okay. What are the syndicate loans? What are the advantages to borrower? And what are disadvantages? Borrower dealing with a single bank. Borrower and the lead bank will sign a loan contract on single contract points and sign all the documents with the lead bank on single documents. So he can avoid stamp duties, he can avoid compliance situations, different terms and conditions by the different bank that can be avoided. Managing is very easy. It's dealing with one bank. Managing the loan by the borrower is very easy. Then the borrower have access to the large amount of funds and also a borrower using a sophisticated investment base. Otherwise, if the borrower want to borrow this money from a market, he had to issue debt instruments. So the investor base is very large. Here only very few through one person, to one bank, that investment entire base is managed by the borrower. Those are the mostly positive advantages for the borrower. Relatively low price and finer terms, highly flexible terms, because I told you earlier, although different banks or different lending institutions are involved, although they have different their policies, their cultures, and their pricing, terms and conditions, all will be ironed off when it comes to syndicate loan. When it comes to syndicate loan. So in the syndicate loan, they negotiate with all the participating banks, will negotiate with the lead bank and come to a common platform with common set of documents where terms and conditions will be applicable to all the banks in the same level. Access to a wide range of banks. Borrower have access to number of banks. He don't have to open accounts. He don't have to open accounts with other banks to deal. But other banks are dealing with this customer through lead bank without any account. Okay. Greater speed and reasonable certainty of obtaining funds. This process is very speed because the corporate lending, we find that syndicate lending, where lead bank will do the necessary analysis, credit evaluation report, maybe with the support of the participating bank, and they also contribute on their analysis part. Therefore, it can be comparatively in a greater speed, the funds can be dispersed. Simpler than other ways of raising funds, issuing bonds and equity. Right? Bonds being what you call debentures and other financial institutions equipments. Arrangement fee, income without committing a capital. The lead bank, advantage of the lead bank, arrangement fee, lead bank is charging a fee called arrangement fee. So without a capital, lead bank is getting an income. Without a capital, lead bank is getting an income. That's called arrangement fee. Lead banks, by having a syndicate facility arrangement, it can enhance their reputation. Also, they can enhance the reputation among the participating banks and on the other hand with the customer. Okay, enhancing the bank's relationship with the client for further business expansion is going to be a big advantage. Advantages to the participating banks are diversification of risk diversification, exposure norms prescribed by the central bank. Risk, right? So participating banks will be take according to their risk appetite. Right? What risk appetite means how much of risk can be absorbed. Up to that point only, participating bank will be participating or contributing for the loan, not for the entire amount or entire higher part of amount. Although the advantages are there, high incomes established, right? No, what you call administrative work in lending by the participating bank. Everything done by the lead bank. So there are expenses on this transaction is very less. Okay, so diversification risk will be also a part of the central bank guidelines. Comes as stress management. That is, what are the stress assets of the bank and how they should be managed, and all these things will be advantages to participant bank, exposure norms, the limitation, single borrow limitation. Access to lending opportunities with low marketing cost. No cost at all. No marketing cost, no advertising, no location, nothing, but the loan portfolio of the participating bank can be increased. The loan portfolio can be increased without any marketing or advertising cost. Opportunities to participate future syndicators. Opportunities to participate future syndications. Means if the participating bank successfully handled with one particular syndicate loan, he is getting opportunity in the future. For the other lead banks will always consider the creditworthiness of the participating bank. Okay. In case of borrower runs difficulties, participant banks have equal treatment, no disadvantages of size, vice versa, dominant bigger bank. Right? Although a participating bank has contributed a very small amount in the participation for syndicate loans, the equal rights for everybody, rights are equal. It is so that depending on the investment, size of the investment, no. It's not in the size of the investment. Right? Equal, no disadvantage of the size of the dominant bank or the small bank. All the banks are equally treated. Then the advantage of participating banks are recognition of as a lending institution. Recognition of the by participating for a large amount of loan, even though small proportionately contribution, the entire package is large, no? Large package, this small bank has been contributed. That recognition is one of the instrument to get good rating by the rating agencies for this particular bank. Return by way of interest and fees, two types of income, interest and fees. And the loan can be transferable at any time. If the participating bank wants to have a liquidity proposition, crisis situation, that loan can be transferred to some other bank, or it can be sold, say buyouts. Can be given for that can be sold, negotiated, transferability. Negotiate with some other bank and sell his loan portfolio, particular participating bank loan portfolio for some other bank. Or even sometimes maybe lead bank, maybe after some, if you find the difficulty, for example, bank A is a leading bank, bank B is one of the participating bank, C, D, E. So sometimes bank C, D, E may willing to take over that particular loan portfolio by themselves. It can be transferred. Or lead bank may take over. If the particular bank B is facing for what you call financial crisis situation or liquidity crisis situation, to assist to recover this type of facilities can vary. So those are the advantages of participating banks. Right. So what are the types of syndications? Types of syndications. First one is underwritten deal. Now, underwritten deal is one of the most widely available types of syndicate loan in Europe. Under this arrangement, the lead agent or underwriter guarantees and syndicates the entire loan. If the loan has not been fully subscribed, the lead agent can up to absorb the underwriting subscription portion. Right. When when the syndicate loan is put forward for participation, I told earlier, underwriting bank or lead bank can be arranged to take over the undersubscribed portion of the credit facility. So that's called underwriting deal. Therefore, giving a guarantee to the borrower that their requirement will be fully subscribed. Although it is participated, the underwriting bank, the lead bank or the underwriting bank will guarantees that syndicate the entire loan will be there. Okay. Then, if market conditions are bullish, the same lead agent can sell to other investors the unsubscribed part of the loan that it has absorbed. Right? When at the initial stage, when the loan is processed, when the entire amount is not subscribed by the participant bank, underwriting bank or the lead bank will take over the undersubscribed portion. After some time, when business is started, while market conditions are bullish, that is growing upward, the same lead agent can sell to other investors undersubscribed part of the loan that it has been absorbed. So the undersubscribed loan can be either sold to the investors or right, straight away the lead bank can take over that undersubscribed portion, and that can be sold on a subsequent day when the market is bullish, that is growing up. However, if markets are bearish, the lead arranger may force to sell any undersubscribed portion at a discount or simply consider the whole thing as loss. So that risk has to be taken over. Right? If the any portion undersubscribed, underwriting can be arranged. Underwriting can be before grant. Normally, underwriting has to be done at the time of negotiating for the participation, not subsequently. So, if you find that market is not moving or the market is stagnating, therefore this whatever he bought, he could not sell. Okay? Then simply consider the whole thing as a loss. Simply consider the whole thing as loss. Yeah. What else? Right. There are several reasons why bank may decide to become an underwriter. First, this type of loan can make financial institution look more competitive. Morale of the financial institution can be boosted by contributing for a syndicate loan or taking a what they call underwriting deal. So I told you earlier, most of the merchant banks, they take that underwriting portion of the syndicate loans. Right? They said become underwrite. That loan can be the undersubscribed portion can be given. So that will be the moral boost for a financial institution. Like I said, they are showing us they are very competitive. figure in the market. Next, the syndicated debt could mean huge profits for the bank because the risk involved in this type of loan can translate to higher service fees. So this is a higher syndicate loan. If you say undersubscribed, it's a high risk. Why is it undersubscribed? Either a participating bank may not have funds to accommodate such type of large portfolio, or individual banks may consider for the risk involving the loan, and therefore this type of loan can translate to higher service cost. That will be compensated by the high fees, not by the interest rate, by the service fees. Service fees can be involved in this type of loan, can translate to high service fees. Lastly, underwritten deals now have floating interest rates. Thus, the risk are no longer as high as the fixed rates. Now, floating interest rate. What is floating interest rate? Depending on the market situation, interest rate may be fluctuate. Depending on the deposit rates, interest rate, deposit interest rates, the cost of fund may change. Therefore, time to time, the changes taken into consideration, the floating interest rate can be applied. So that type of a arrangement is very important, because if the fixed rates are there, anything happens, they can change the rate. Although the money, what they call money market and the call money market, and their dealing rates are very low, then they feel high risk of default. Lastly, underwriting deals now have floating interest rates. Yes. Lastly, underwriting deals now have floating interest rates. Thus, the risks are no longer as high as this with the fixed rates. Now, most of the banks now applies floating interest rate, not fixed interest rates. That means, depending on the market changing the interest rates, the banks will also change interest rates. So this can be applied for syndicate loans also, floating interest rate, depending on the market rate. So mostly quarterly, go for the weighted average lending rate, fixed service rate plus 2% or 3%. That will be applicable for even for underwritten deals. Right. The second deal is second type of syndicate facility is called club deal. This type of syndicate usually entails a small amount, typically between 25 and 150 million. This main feature that makes this type of syndicate loan unique is the fact that the lead agent and other members of the club deal consortium shall share equal or nearly equal parts of the fees earned from the loan facility. Right? So they get the equal return. The club deal, lead bank, and the contributing institution. They get a unique fact that they share equal and earn equal facilities. Now, earlier we discussed different participants can go for different levels of shares of equity custodian or the participation. But in the club deal, almost they come to closer equal amount of sharing. For example, it's a 1 billion 4 banks are coming involved, lead bank and 3 other banks. All the banks are sharing 250 million each for individual bank as participation. So they are, whatever income generated from the loan facility also shared equally. Then the other one is best effort syndicate deal, the third one, final one. What do you mean by best effort syndicate loan? All the types of syndicate loans, the best effort syndicate loan is the most commonly used in United States. Under this arrangement, the lead agent does not commit or guarantee the entire amount of loan. Right? The lead agent or lead bank will not give a commitment to or guarantee the entire amount of loan will be subscribed by the participants. Okay? Any undersubscribed portion of the loan will be filled up by the taking advantage of changes in the market conditions. Right? Undersubscribed portion of the loan may be filled up by the lead bank depending on the market conditions. Whether it's a bullish market or bearish market, whether the customers' evaluation which are done may have changed during the short period due to certain reasons. Therefore, the underwriting arrangement of undersubscribed portion will be taken depending on the conditions, market conditions. However, if the loan continues to be undersubscribed, the borrower may be forced to accept a lower loan amount or the loan agreement is cancelled entirely. Other agreement is if it is undersubscribed. Borrower may be forced to accept a lower loan amount, that is, whatever contributed amount will to be accepted, and undersubscribed portion has to be left off, or the loan agreement is cancelled entirely. Two options, whether to accept it or not. That means the lead agent does not make any commit or a guarantee that entire loan amount will be collected from the participant banks and lent. They are not giving a guarantee. Therefore, it is on the hands of the borrower to accept it as it is or just to cancel the entire agreement. This is called best effort syndicate deal. Lending instrument can be go for long-term revolving facilities, standby facilities. We discussed on the first slide. It can be term loans or short-term, medium-term, and long-term loans. Then the revolving facilities for working capital, and the standby facilities for import-export trade. The prospective borrower, what are the stages in syndicate loan? The prospective borrower may liaise with a single bank or it may invite competitive bids for a number of banks. The lead bank need to identify the needs of the borrower. Credit need has to be evaluated. The credit packaging has to be developed by the lead bank. Deciding an appropriate credit structure. What type of credit needed? Is it a working capital finance, short-term finance, medium-term or long-term? Prepare a structure. Develop a persuasive proposal, attractive proposal to the participating banks. On approval, award the mandate. That is a agreement has to be signed by the lead bank and all three parties. Okay, so that's all about syndicate loans. Basically, syndicate loans are commonly used in other countries for large, large financial markets. We have countries which have large financial markets and quite large prospects of demand for credit. In Sri Lanka, we don't find in the recent past. I told we have come across any syndicate loan facilities, but a small amount of syndicate loan was there some time back with the I think Singer made an arrangement for a syndicate loan for the expansion project, right? So the electronic manufacture of electronic goods, Singer free. All. Other than that, there should be a developed capital market, developed financial market should be there. This type of products can be useful to the country. Otherwise, the banks traditionally go for lending requirement, right? So I told you what are the documents. The process is one single loan agreement. When it's a property mortgage, it's a concurrent mortgage bond. That is one mortgage bond with the different uh, beneficiaries in the mortgage bond. That different participating bank will be the beneficiaries. Other advantages in this, in any case of if one participating bank won't take legal action against the borrower, it is permitted, allowed. Permitted, allowed, can take action against. If any bank to get rid of the participation from the uh, syndicate, it also provide at any time we can withdraw. And he can sell his share to the any other bank or the leading bank or can put it into the market. Sell to any other external organizations, which has to be accepted by the lead bank. Okay, right. Well, so we'll have a small break. We'll have tea break and come back, and we'll continue with the other session of venture capital finance. There's another corporate type of lending is venture capital finance. Okay, right. Okay, shall we start? Shall we start? Hello? Hello? Hello?
Yes, sir. Yes,
Can
sir.
you see
Can go
the
ahead.
screen? Can you see the slides?
Yes, sir.
Okay, sure. Got it. Now, next item is we are going to discuss about venture capital financing. It's also a novel concept uh, about recent, the 20th century innovated instrument, venture capital financing. So what is a venture capital financing, how it is operating, and how the banks can involve in venture capital financing, and also what are the features and present position of venture capital financing in Sri Lanka, and how the operations of venture capital financing is carried out. Okay, what is venture capital financing? This if you make the word venture capital. What is a venture? It's a project undertaking involving a risk. So dare to do or say something. Venture. So definition of venture is an undertaking involved in risk. High risk or medium risk involved project or event. An event where a risk is involved, so called a venture. Or dare to do or say something, is also called a venture. Sometimes, because of the nature of the investment is high risk. Nature of the investment is high risk. Therefore, this Okay. Therefore, the investment, lending, different type of what do you call investment type, it's called venture capital finance. Capital is amount invested by the persons to carry out the, especially a newly established business. Most of the time, the venture capital is going for new startups, new business. The capital means equity. Capital means equity, amount invested by the person to carry out the newly established business equity. So in other words, venture capital finance means equity contribution for a risk-involved project. Capital investment for a risky project or to take our high risk project. It's called venture capital. Okay. The capital is funds employed in any business activity. Capital is employed in any business activity to earn a profit. To earn a profit. Right? Capital investment to earn a profit. Most important factor for investment is the production. No economic entity can function without capital. So financing for capital is venture capital. Finance for capital. Venture capital is significant innovation in 20th century. It is generally considered as synonym of risky capital, equity capital. Venture capital is new financial service, the emergence of which walls towards developing strategies to help new class of new businesses. Right? Therefore, venture capital is equity support to fund new concepts that involve high risk and at the same time have a high growth and high profit. Okay. Venture capital broadly implies an investment of long-term equity finance in high-risk projects with high rewards and possibilities. So when you take both these definitions, it's an equity support to fund new concept and involve a higher risk at the same time have a high growth and profit. There's a high risk. Due to the high risk, there can be higher profit. And the potential of growth of the business is exhibiting, and therefore equity support need to fund that concept. It's called venture capital. In other words, it's an investment of long-term equity finance in high-risk project with high reward possibilities. What does it imply this? What does it implies? We need to discuss in this on the surface of it. Venture capital broadly implies an investment of long-term equity finance in high-risk projects with high reward possibilities. In other words, this is not a loan. Normal loans are given for short-term and medium-term. Venture capitals are given beyond that scenario. There's no time factor, like a loan. Second important thing compared with the loan is venture capital, there's no loan repayment. Venture capital, there's no loan, therefore there's no loan repayment. Right? Loan, you are charging interest from the day one it has been given, where the venture capital is equity finance, therefore the profit, till the profit generation, venture capitalist does not get any return, and when profits are generated, venture capitalists get the return by the way of profit for his investment in capital. This is the broadly difference between the loan and venture capital. Therefore, these two nature, commercial banks are not directly involved in venture capital financing. The commercial banks are not directly involved in this venture capital financing. Mostly the what you call investment banks and merchant banks are involved in this type of facilities for startup businesses. Okay, commercial banks are looking for short-term return as return profit or interest. They are in the venture capital. It is not there. Therefore, they are not interested in investing that type of projects. Now, when you look at what is the venture capital financing, there are 3 stages. Oh, sorry, 5 stages. 6. I changed the slide. It has been gone out of the way. Look here. Continue. Sorry. There are 6 stages in venture capital financing. First stage is called seed money. Low-level finance need to prove a new idea. When new business or new venture is going to be innovated, especially now venture capital, we are talking about doing for SMEs, small and medium entrepreneur development programs, without giving credit. If you give credit to the customer, he had to pay the loan whether customer has generated cash flow or not. He has to pay back the loan installment. If you are not paid in 3 installment, it is becoming an NPA facility. So most of the instances we find lending to SME sector is in a disadvantages because our loan structuring system is not supporting the cash flow of the project. Therefore, it is proven venture capital is one of the alternative source of financing for this small type of startups, where there's no loan installment, there's no recovery of loan installment till the business is established, and earned generated income and profit. Okay. So the seed money is the money which is invested for initial capital investment. Seed money is the initial level. That means for a startup business, customer need a certain amount of money to purchase land and building, start up with the machinery and machinery, right? To purchase raw materials. Those called seed money. Seed money is called, which is going to seed, going to plant in the, invest in the business. That's a basic investment. Then second stage of venture capital comes in the startups. When the business startup, when you're growing, early stage firms that need funding for expenses associated with the marketing and product development. That is specifically working capital financing part. Startups needed working capital, marketing and product development, where expenses are there incurred day-to-day operation startup. So once a business is established, that costs seed money. Then startup business called venture capital and product for the working capital. Okay. Then the first round of investment comes with when the sales started. Manufacture started and sales, starting sales. Now up to manufacturing processing time till the sales are realized. Right? And manufacturing funds is the revolving funds needed for ongoing basis to invest in the manufacturing process. That is only once you have to give. Then that will be revolved over a period of time, number of time for a year, and it will generate income. Right? So it will generate sales. Then the fourth stage will be second round, working capital for early stage companies that are selling product but not yet turning a profit. It's called working capital. The second round working capital is called permanent working capital for stocking of raw materials and financing of debtors. Okay, selling product but not yet turning a profit. To turn a profit, it has to be realized. The debtors has to be realized. Right? So it may take about a number of periods, 30 days or 60 days, depending on that, to take time. Then the third round is the fifth stage, also called mezzanine financing. This is expansion money for newly profitable companies. Then business is started and it is started, sales are started. Until the sales are started, we are given the loan should give as a grace period. The period is not considered known in venture capital. Therefore, till it realize the sales, it will not generate profit. After that, the expansion, third round is given for once the sales are started, profits are generated, and business to be expanded. Business are expanded. The fourth round is the sixth stage, also called bridge financing. It intends to finance the going public process. Once a business is established, the business is, for example, started as a small project with a sole proprietorship, for example. Now it can be diverted for a public process, converted into public company, where shares can be sold on the market. It's called bridge financing, intend to finance going public process. Right? So once it going to public process means the shares of that business company can be traded in the public. Okay, so when the shares can be traded in the public, the important part is the initial investor. The initial investor can sell his investment. Now it has converted into shares with a bearish environment, that is the bullish environment. That is the profits are generated, business is doing well, the share prices are increasing. So initial venture capitalist can sell his shares in the market and take back his capital. During this period, the profits are generated, and after starting generating the profit, the venture capital is getting it returned by the way of profit. In otherwise, it's called as profit sharing business. It is not interest focused investment. It is a profit sharing investment. Till the profits are generated, venture capitalists have to wait and see, patiently wait till the businesses take off, earn sales. When the sales are coming, profits are generated. The profits are generated well, then the venture capital gets his return by the way of profit. When business is improving, third round of financing needed for expansion, and fourth round will be going out to the company will be going for a large company. So it is converted into a shares, capital will be converted into shares. So venture capitalists can get his return, but his investment back at this stage. During this time, he getting a return as profit on the company, and now he can take back his investment by selling his shares. And he get two types of advantage. One is he's getting a profit from the company on the operations, and finally, when he sells when the company is created, going public process, public company is created, he can sell his shares with a very higher price, incremental price. That's called it's a dividend. Okay, so dividends is generated, so the profit, and also he is getting his investment sell at a profit. So he is getting back his money the dual way. So that's the difference between loan and venture capital. Loan is installment are recovered on a monthly basis or arrangement basis, whereas venture capital, there's no capital return until the shares are sold in the market and recovered the money. Okay. Post within the venture capital firm, venture capital general partners, also known as this case venture capitalists or VCs, are executed in the firms. Right? Venture capitalists, that is who are invested in the capital as a venture capital, can take part in the management of that company. Whereas that advantage is not there when you take given a loan. When the loans are given, the banks or the lending institution cannot interfere with the business, management of the business. Because venture capitalists, capital investment, therefore, venture capitalists have the right to run the business. That means part as a partner or can involve in the business as executive in the firm. Then, second role is in the venture capital firm, limited partners. Investors in venture capital funds are known limited partners. So they are not involved in the business, but they are watching the business as a partner in capital investment and waiting for the profits. When the venture partners are bring in deals and receive income only on deals they work on. Venture partners can work as in the company and get the income also on their deals. Fourth one venture capitalist called entrepreneur in residence. Entrepreneur in residence are experts in the particular domain and perform due diligence on potential deals. Entrepreneur in residence are engaged by venture capital firms. Some, some entrepreneur in residence move on to roles such as chief technology officer at a portfolio company. So, depending on the venture capitalist, the investors, technical knowledge, he will be taking a part, an important part in the potential deals for due diligence. Entrepreneur in the sense mean they are experts in particular domain and that so they are involved in the business, right? In the management partners. Sometimes can be our technical officers, sometimes there can be financial managers, some can be personal managers. Likewise, venture capitalists can use in their expertise in the play a role within the capital firm. Okay, so there are four types of roles we can identify: general partner role, limited partner role, venture partner role, and entrepreneurial resident role. What are the features of a venture capital? The main features of venture capital are long-term horizon. In general, venture capital undertakings take a long time, say 5 to 10 years at a minimum to come out commercially successful. One should thus be able to wait patiently for the outcome of the venture. Right? Now, this is a very important concept in the venture capital financing. Whoever invests invest in the venture capital or involved in the venture capital to get a return from the venture capital can wait a long time without any return. Where banks and financial institutions cannot do that. Banks and financial institutions are needed their investment as loans because they are investing others' money. Therefore, the money has to be returned back to the investor, that is the depositor. Therefore, that money has to come on the frequent intervals. And the return for that funds, they have to pay interest. Therefore, interest has to be recovered regularly. The venture capital, these two are not taking place. Therefore, that's because the main difference between a loan and venture capital is that. So venture capitalist has to wait till the business is successfully operated, commercially viable, and where they generate sufficient profits. Right? Second important feature in this venture capital is lack of liquidity. Since the project is expected to run at a startup stage for several years, liquidity may be a great problem. Right? Lack of liquidity means as the further funds are coming to the business. Why the liquidity crisis arising? Because startup business to generate sales take a long time. Sometimes some business may take several years. They may earn sales, but it is not sufficient to cover up the day-to-day expenses sometimes. Till it get established, it takes number of years. So within that period, liquidity may be a greater problem for venture capitalists. Then the high risk. The risk of the project is associated with the management, production operations. That's a high risk because it's a management risk. It's a management risk. Product risk and operational risk. It's very high because it is not generating any income. Therefore, the risk cannot be mitigated. So risk cannot be mitigated. Risk has to be absorbed to the project in the long run, not in the short term. So therefore, these three major events, features of a venture capital, we have to carefully understand. Long-term horizon, lack of liquidity, and the high risk. Right? Then next item is high tech. However, venture capitalists look not only for high technology, but the innovativeness through which project can be succeed. Using high technology, right? But innovativeness through which the project can succeed. What are the new avenues? Venture capital always looking for the innovative products through their business, through their activities. So which can convert stability and profitability. Okay, it can convert stability, generate stability in the long run, and also convert a profitability. The innovation can be converted into profitability project. Then equity participation and capital gains. A venture capitalist invests his money in terms of equity. Venture capitalist invests his money in terms of equity. That is a capital. He does not look for any dividend or other benefit. This is a very important feature in venture capital. He does not look for any dividend or other benefit. But when the project commercially succeeds, then he can enjoy the capital gain, which is his main benefit. The project commercially success, operative viability, started generating profits, then he can enjoy the capital gain, that is selling his shares in in the market price, shares in the market price, higher rate. So it's an advantage, but that is his main benefit. Waiting for long term, he may get a capital gain. That's an important feature in the venture capital. Participation management, unlike the traditional financial banker, the venture capitalists can provide managerial expertise to entrepreneurs beside money, beside their investment, beside their return on their investment. So they can involve in the business because they are invest in the capital, therefore they are partners of the business. Venture capital is a partner of business. Right? Right. So if you look at venture capital concept, it is the basis of Islamic financing. Islamic financing, the basis is venture capital. That is giving a capital, not loan, not expecting a return as an interest. The profit generated for the business, share the profit. In other words, invest to share the profit, not to earn the interest. That's the concept in Islamic financing. So therefore, this is taken as an innovative product in 20th century and rolled out to try in the market. In some areas, it has been very successfully implemented. Let us see what are the advantages of the venture capital. It is economy oriented. Number one is economy oriented. Helps an industrialization of the country. Now taking into consideration our present position of the country. a lot of small type of industries can need it to start production. Export-oriented products, import subsidies products are mostly needed today to earn our foreign exchange. So the venture capital is one of the best solution for industrialization of the country, which has started for a long time with the political intervention. But unfortunately, because of the political intervention, the successful of that projects are gone defaulted. Because there's a loan repayment, funds are given for long term, no return to be paid to the government or no return to the investors. Therefore, it became a threat. So, if you had done it in a correct way, helps industrial country can be developed into industrial developed country. Okay. Can you get an example? What is the Bangladesh position today? Today, Bangladesh in the South Asia leading economically developed country. Secondly, Pakistan, third, India. We are nowhere now. We are borrowing from Bangladesh. What is the secret behind? What's the secret behind? Can you remember some time back, about 10 years back, the Grameen Bank was established. Barefoot bankers in Bangladesh. Grameen Bank, barefoot banker concept has been developed, and it has been this venture capital finance was the basics. Under that, the entire country was developed. The small entrepreneurs had contributed to the in GDP of the country. Now, today, Bangladesh is a growing nation in the world. It is number one in the South Asia now. So this venture capital finance is, if taken up correctly, it have a lot of advantages to the country. Helps in technological development of the country. Basically, the technology development, using the new technology, innovative products, innovative things can be developed. And so, whenever start a new concepts, the entrepreneurs try to develop their own technologies, innovative technologies, not to copy others' technology, their own technology development. So it will help the country to develop their technological background. It generates employment. It generates employment. Helps in developing entrepreneurial skills. So the entire economy can be developed. It's economy oriented. Industrialization, technical development, employment generation, and entrepreneurial skill development. This will help, in turn, the economy can be developed. So I give the example, Bangladesh. Then investor oriented. Second advantage of the venture capital financing is the investor orientation. Benefit to the investor is that they are invited to invest only after company starts earning profits. So the risk is less and healthy growth, capital market is interested. When the entrepreneurs, the investors are invited to invest in the business only after company take off and earn profits. Until such time, Venture capitalist, the seed money and the second generation money is only needed to start up the business, generate the profit. So the risk is less and healthy growth of the capital market is interested. In other words, when the profits are started, the companies I told, generating profits, new businesses, generating profits. The venture capitalists can sell their investments in the capital market and earn a profit, capital gain. Thereby, the capital market is also growing. Profit to venture capital companies. So investors are, venture capitalists, investors are not looking at the interest return in the short term, but long-term profits are expected. Venture capital companies generate profits and the profit is distributed among the investors. Help them to employ their idle fund into productive avenues. So if any organization having idle funds are there not utilized for any economical purposes, can put in the productive avenues. In Sri Lanka, we take, there are three major large funding products. Employees trust fund, employees provident fund, and the pension fund. So investment to that, the money contributed to that funds, fund managers can use that funds to this type of venture capital finance in the long term and get return. So that funds will be utilized for productive avenues without investing those in gilded securities. Productive avenues. What's happening now? Presently, what is happening? Right? All these funds, provident fund and employees provident fund, trust fund, they try to invest in the banks and financial companies to gain an interest. The interest is very, very low. It may be not sufficient to service or repay the claims by the and the members of the provident fund sometimes. These are very common factors in Sri Lanka. We know that those funds are not utilized productive avenues by the fund managers. So they can use these funds for project like venture capital. There again, you have to identify correctly the correct investor. Then entrepreneur oriented. What is entrepreneur oriented? Finance. There are a number of features there. The venture capitalist injects long-term equity finance, which provides a solid capital base for future growth. Inject equity finance, capital finance, finance in the mode of long-term finance. It will not be taken back till the company generates the profits and company establish the business. After that, only venture capitalists try to sell their capital base to earn a profit. Okay. It's a business partner, entrepreneur. Venture capitalist is a business partner, sharing the risk and the rewards. partner in the means equity partner, investing in the equity. Therefore, he is sharing the risk of earning profits and rewards as profits. Okay, so not anything in the short term. All these things are long term. You have to wait patiently until you get the return. Okay. Now, when the entrepreneur has to system mentoring, what is mentoring? Giving advice or directions. We discussed a little while ago, last session, chapter, that venture capitalists can use their expertise, knowledge in mentoring staff of that particular business to develop that this customer the staff members by mentoring to develop their knowledge and technical know-how. Alliances. The venture capitalist also has a network of contracts in many areas that can add value to the company. Okay. What is that? The venture capitalist also has a network of contacts in many areas that can be added value to the company. Network contacts, as in different fields. They have the network of contacts in different with technology, accounting, manufacturing, processing, the network of people contacts to get their knowledge and expertise shared to development of this. The other entrepreneur-oriented feature is facilitation of exit. The venture capitalist is experienced in the process of preparing for company for an initial public offering and facilitating in trade sales. When the business company is established, earning profits, venture capitalists can exit from that business. How? The venture capitalists experience the process in preparing the IPO, public offering, share issue, convert that business into a public company and the shares to be issued. So the venture capitalist can sell his shares in the capital market and gain in turn what is returned. Invest in the return can be getting back. Also, a gain, the capital gain can be earned by the way of selling at a higher rate. Other one is, higher rate. So, in the trade sales, okay. So now, what is the process of venture capital financing? Starting the deal origination. The business has to be looked into, and a deal has to be developed. What type of a business is going to start up? Especially we're talking about venture capital. Most of the instances for startup businesses, startup projects, startup manufacturing organization. What is the business? What is going to be manufactured? What is the deal? How much of investment needed? And plan out how long it will take to take off from the ground. Seed money invested, and it will grow up. How long it will take to take up? And when they take up, there is screening. What are the external factors affecting the business? Okay. Second second step will be screening the viability of the project. Short term, medium term, long term. For example, we take a project. Now, recently, the government has banned using unorganized fertilizer and pesticides, chemicals, pesticides, and the fertilizer. Now there's a big opportunity created in the environment to manufacture organic fertilizer and organic pesticides. There's a big demand. Now banks also started intervening on it and giving certain lending, very small, what you call interest rate, low interest rate loans are started giving. So venture capitalists also can screen this project in a long-term basis. Short-term, how long it will take to establish. And then how long it will take to take off. When after take off, what would be the position of the business? Expanding the business to the geographical areas. What type of product, organic, what type of what particular innovate something with the technology to meet the specific need of certain agricultural products. So paddy cultivation, what are the needed, what you call nutritions to grow up paddy successfully. So those nutrients can be developed in organic fertilizer without adding chemicals. What is needed for fertilizer? If we have seen in the chemical fertilizer also, this segmentation is there. Flower bearing, one particular chemical, which is needed to find out what the enzyme needed to grow that particular thing, to seeds and to grow up, right? And further, what type of hormones or is needed to pesticide. What are the insects coming? How to control that? What are the ingredients needed? What are chemicals can be created through organic methods? The novel is called Green Revolution. So this can be screened, and once you establish, it can go for large scale. Starting with a small scale, the area can go large scale. So when you're given a loan, the loan will be limited to certain developments, to certain areas only, certain sectors only, certain levels only. When you go to venture capital financing, there's no limitation of growth. There's no limitation of growth. It can go further and further. Then the due diligence, evaluation, venture capital. Carefully evaluate the probability, the viability, and technical know-how, how it has to operate, can be operated. Then the deal structuring comes with the convert this venture capital into saleable or transferable instrument, that is converted into shares. and put in the share market, IPOs, initial public offerings, or can be dealt with privately if needed, selling the shares. Then post-investment activities. After the company's broad-based activities, whether they have an exit plan. The venture capitalists should have an exit plan, whether if he needed to sell his shares and come out from the business, there should be a plan incorporated in the venture capital deals. So this process is very important to understand, to carefully process the venture capital. Now, what are types of venture capitals? There are basically, we can identify 3 types of venture capitals. First one is angel investors. And second one is financial venture capitals. Third one is strategic venture capitals. Who are the angels? Typically, wealthy individuals are angel investors. There are certain people have a large amount of money. They don't know what to do with that money, how to invest that money. There are certain people are there in the even in Sri Lanka. We find sometimes I come across certain wealthy people. They have money. They don't know what to do with the money. So those are people who are identified as angel investors. Often with a tech industry background, a position of judge high-risk investments. Angel investors are individuals who have sufficient fund. Millionaires to find they have insufficient fund, and they are reluctant to invest in the banking field due to tax, right? Due to payment tax, and also interest is very low. The return is very low. Therefore, they keeping their money with them without any investment. So those are the type of people can be collectively taken into one cluster or a club and form a investment in venture capital investment forum. All right. Often with a technology industry background, in position to judge high-risk investment, right? Can judge high-risk, what are the high-risk investments in the market, where the banks are reluctant to invest, which has a high potential to grow and earn high profits. We need some organization to investigate into this if you're going for venture capital financing, right? Some organization has to look into what are the high risk investment using the technology, and because high risk, the banks are not going to put their hands in that. Therefore, these wealthy individuals can be organized to invest in that field. Usually small investment, $1 million in a very early stage company with 2 or 3 employees. Starting with a small investment, it can be goal with the development. What are the motivating factors? Dramatic return on investment via exit or liquidity event. Dramatic return, high return can be initiated by exit. Exit means selling their shares of the venture capital. When the business is taken off and profits are generated, they can exit. or liquidity event. Right? It can be converted into liquidity by public IFO of a company or subsequent financing rounds. So once a business is established and developed, and the business want to expand their business, open up now factories, open up new what do you call markets which need funds, so these investors can reinvest their funds. Angel investors can fund. Interest in technology and industry is a very common. It's an Indian scenario where the technology. We know that Indian scenario, high growth in technology industry, mostly is due to the investors. I was in India, went for a training program. It's high advanced diploma in credit management at NIBM Pune. Somewhere in 1980s, late 80s. So we were taken to an industrial city in Pune. We just starting that industrial city, not even just starting. So the most of the factories were started there is high-tech technology. Those days are what you call technological goods are they are manufacturing for Germany and United Europe markets. So India now number one in this technology development. Now backed by these wealthy individuals, by venture capital, not the government investment, the venture capital investment. So we learn a lot of things from there about them, how they operate this system. It's our case study to learn in the our course. Okay, so angel investors are typically wealthy individuals who are having high good wealth. They are searching for avenues to invest that to earn a profit, to grow their wealth without interest or investing in the banks. Then the financial venture capitals are the second type of venture capital. Most common type of venture capital is the financial venture capitals. An investment firm, capital raised from institutions and individuals. One organization, one investment company will raise the venture capital from the different institutions and individuals. That wealthy individuals as well as housing funds, the other funds are where generated places where funds are available. Use those funds. Other financial venture capital. Organized as formal VC funds with limits on size, lifetime, and exits. The formality is same. Right? So a company, investment firm, they will establish and they get all the investors who are having funds pooled into their company, and they will be organizing venture capital funds for needy people. That's called financial VCs. Sometimes organized as a holding company. Investment company, investment firm who originate the idea, get the investors to invest in that company, and that company will in turn invest in the venture capital. But the concept is same. People who have invested, they had to wait. Their money will be invested in their own name, not in the company's name. This company is a holding company. Money wealth got from the investors will be investing in their own name, and therefore they can, when they can exit at maturity, or when the funds are grown, or can generate profits directly from the investments. Then fund compensation, they carried interest. Compensation also, investment can be, interest can be carried out. Holding company compensation is IPO. Holding companies compensation for their transaction is the, when it comes to IPO, initial public offering, they sell the shares in public offering and gain a capital return. Right? Motivation of doing the financial VCs are purely financial maximize return on investment, IPOs, mergers and acquisitions. By the way of IPOs, mergers, that means similar type of companies can be merged together. Or one company can acquire smaller companies. All these are commercially viable projects. Right. Next important thing is strategic venture capital. Typically a small division of a large technology company. Examples: Intel, Cisco, Siemens, AT&T. These are all Indian companies. So all examples are from India. So we don't have such big companies, except for Dialog. I'll come to that later. Intel, Cisco, Siemens, AT&T, they use venture capital as strategic venture capital to manufacture and develop their as a subsidiaries. They are subsidiary companies. Corporate funding for strategic investment. They fund strategically by these companies by the way of venture capital, funding for strategic investment, that is to manufacture certain strategic components of their producers for their company. So in other words, these VCs, the venture capital companies, are subsidiaries of the large technology company. Although it's a subsidiary, funds are invested from the as venture capital. Help companies whose success may spur revenue growth of VC corporation, venture capital corporation. It will be generate more profits, more income if the companies successfully operated. Growth, development, growth, business will be growing. So those, once it goes, it can be converted into a separate organization or institution away from the large technology company. Start as a small division of a large technology company, and time to come when it's developed, it will be created a new company, but they by their own. It's called strategic VCs. Not exclusively or primarily concerned with the return on investment. There's no return directly. It is the capital gain always. May provide investees with a valuable connection and partnerships. Who invest valuable connections and partnership with other organizations. Okay, typical take a backseat role in funding. Strategic VCs are not involved in the business. They are always in the backseat. They fund and they watch for the development, being in the backseat. Okay. Right. Now this is a concept of venture capital how it started in 20th century. Now the 2 decades are gone already. To what extent in Sri Lanka it has been developed? What are the background of this industry in Sri Lanka? And what are the features and important factors which is not rooted in Sri Lanka? It has started earlier. I can remember when a lot of projects came when we were in the banking sector. I can still remember 20 years back or 25 years back, this venture capital financing system was tried to introduce in the banks. But banks are not accepted because the nature of the venture capital is not going along with the banking principles. We had to give a return to our depositors as agreed, quarterly, half-yearly, or annually, which cannot be met with the venture capital. So always banks are may face for liquidity crisis situation. Therefore, it has not been successful in Sri Lanka. Even now, the government tried to develop this venture capital. Still, it's not easy to inculcate the concept of venture capital within the minds of this capital, interest-based capital markets. That's a problem we are having at the moment. We cannot go ahead with the venture capital schemes. Right. Let's see to what extent the SME sector can be developed by using this venture capital in Sri Lanka. What are the researchers done and what are the outcomes of this in the past? This also sometime about 5 years back, 5 or 6 years back. Most development experts agree that small and medium-sized enterprises, SMEs, can be effective at reducing inequality and promoting economic growth. Inequality and promoting economic growth. According to the Center by 2018-2017 report, we look at the thriving sector in the Sri Lanka economic growth. This is Mangala's budget, it was established. These two factors. The thriving factor in Sri Lanka economic growth is the SME sector. So he have introduced number of parameters to improve this SME sector. In 2018 budget, Mangala Samaravikrama's 2018 budget, last budget, he have introduced compulsory lending to this sector. 25% for this sector on the total deposit base of any commercial bank. 10% for agriculture sector. It was coming from 2009. And 10% for SMEs and tourism sector on the total portfolio. 10%. Then 5% for youth and women who are doing SME sector finance. It's a budget proposal. It's compulsory lending for the banks. Then the budget itself says any bank is not fulfilling this requirement, that amount has to be deposited in the special account in their central bank. Okay. With that, I think the Yahapala government have bought Enterprise Sri Lanka schemes. But unfortunately, all are based on the loans, interest-based loans, not on venture capital. Okay. So therefore, we had to look in a different angle to develop using these technologies, these techniques to promoting our economic growth. Yet SMEs need equity to grow their business. Internal cash flows are often insufficient, and without adequate equity, banks turn their noses. Okay, so banks are always look for their cash flows, which are insufficient funds for repayment. These projects are not viable. There's less certainty among development experts, however, on the best way to help SME access that equity. Right? Developer expert, however, the best way to help SMEs are the developing equity. Okay, I think this report date I have not given, no. So I think 2000, last I did was 2017 or 2018. This project was brought. ADB looked into this issue in Sri Lanka and recently released a report. Asian Development Bank looked into this issue and recently issued a report in 2018. This report has been published. On its findings, although the country has few private equity firms, they have enjoyed some recent momentum and have provided equity to successful small businesses that want to expand. Right? There are some of the private equity firms. Right? Some momentum, they have provided equity to successful small businesses. Sri Lanka also has angel investors. Who are the angel investors? Wealthy individuals. Sri Lanka, this is the findings of the ADB, Asian Development Bank. Sri Lanka also has angel investors that make small investment in the startups that often have little more than simple plan, simple business plan. The middle space between private equity firms and angel investors is traditionally occupied by venture capital firms or VCs. VCs specialize in VCs specialize in investing in firms with proven business ideas, but need more equity to expand sales. In Sri Lanka, this middle space is a chasm. Okay. VS wouldn't have much difficulty finding promising Sri Lankan firms led by smart, hardworking entrepreneurs. But their problem would arise 4 to 6 years later, when the VC needs to resell its investment in order to return the money to investors. The questions, quit plus exit risk. So they found the risk thought of exit. When the venture capitalists develop, the concept is startup generating profit. The company has to be converted into investment business. Can just money market instruments has to be developed to sell out their venture capital. Now that exit, which essentially is not there as a risk. There's a second problem in Sri Lankan society. SMEs may not want the money. SMEs may not want the money. Or more accurately, SMEs may want the money but are unwilling to relinquish the control that VCs would typically expect. Understood? SMEs may not want money. We don't want money. Why? Reason. Or more accurately, SMEs may want the money but are unwilling to relinquish with the control that VC would typically speak. When the venture capital comes, the venture capitalist invests his money and he has the right to involve in the management of the business, which is not wanted by these SMEs. Therefore, they don't want this money. Now, see what are the findings in the Asian Development Bank. Okay. This suggests that any Sri Lanka intervention should first be piloted. Within 3 years, we will know SMEs have appetite for equity in these firms and if the returns are real. If the real returns are established, within 3 years, this situation will be changed. That is expected, but it never happened. Now, 3 years, 6 years passed. Still not happened anything. A pilot, of course, raises the administrative costs, which are now being spread over a smaller base and create a further drag on returns. A pilot project has to be developed. Yet this makes the case for government support even stronger, for its interest will not be in capturing over rupee of upside, but rather developing a new conduit for VCs to reach promising SMEs. So government has to formulate into this sector, small enterprises developer sector. Right? This is the proposal given by ADB. Right. Now, what are the support for the Sri Lanka Small Business Venture Capital Fund? Asian Development Bank, ADB, is to help Sri Lanka to set up venture capital fund for small and medium-sized enterprises who face difficulties getting access to finance. Okay, so ADB now formulating a venture capital fund either by private small angels or financial venture capitals. The Asian Development Bank setting up a initial already set up the venture capital fund. The support comes in response to government request to ADB to formulate a plan for venture capital fund for SMEs. And it is aligned with the lending agency's interim country partnership strategy. Okay? Unfortunately, we can continue. Sri Lanka lacks vibrant capital market to support investment and economic growth, with the financial market dominated by the banks. This is the weakness we are having. Although the venture capital principles started, the exit, we discussed earlier also, exit is difficult. Why? Lacks of vibrant capital market. There's no vibrant capital market to sell the shares in the market. Investment or economic growth, with the financial market are dominated by the banks. The banks does not want venture capitals to take up their business. They are interest-oriented business. ADB said it will also assess the feasibility of SME credit guarantee facility. Right? Now this guarantee facility, can you remember? Enterprise Sri Lanka ke eka product ekata ADB me guarantee එක දෙනවා. Credit guarantee දුන්නා. Equity finance වලට. 2016 වල මේක publish කරේ, right? Equity capital is still constrained in SMEs. The venture capital industry nascent stage with only 0.1% of total assets of finances in Sri Lanka in 2014. The bank said this was partly due to lack of risk management expertise and insufficient funding for long-term strategic investors for future growth. Still, 2016 वल में fund एक raise करे, 2018 वाला budget taking enterprise Sri Lanka के make roll out करा, अदर वो तब थे, God knows. So this is an innovative product. It's an innovative product. But you may find this product is, I told earlier, practically applied in one of the banks in Sri Lanka. And not only a bank, certain banks in Sri Lanka, they applied under the name of Islamic financing. Venture capital financing is the basis of Islamic financing. So the prohibited interest, profit sharing. Profit sharing. They are not giving credit, but giving asset to businesses to earn profits and return back the value of the asset by the way from the profits. Buyback and payback method. Okay. Right. Now, the Digital Innovation Fund aimed to develop hopes of rupees 2.3 billion into high potential Sri Lanka startups. Will invest most of the fund into early stage companies with investment ranging between rupees 50 million to 200 million per company. The fund will also set aside 20% of its total amount to invest in startups in their seed stage, especially those which are looking for investment below 40 million per company. 2.3 billion the innovation fund Asian Developer has given to start up these funds in 2016. Project formulation. So this is the role for us to intervene that. In addition to financing, the fund will provide support for startups and businesses through mentoring, knowledge sharing, and business development. Potential investees will also gain insight to the marketing and other critical business processes, leveraging strength of Smart XRTR Digital Innovation Fund, a similar venture capital fund that was set up to support incubation programs in Cambodia. How do we? Who is this? Smart XRTR Digital Innovation Fund in Cambodia. Dialogue. Now, Dialogue has set up venture capital fund in Cambodia, where the venture capital to innovative products to manufacture their technology, what do you call, technological requirements for the company. This will further help create a real value that remains untapped. So, what is our position? What is our position? Why Dialogue has not initiated this in Sri Lanka? Why they have gone to Cambodia? Questions are still open. The fund will be managed by BOV Capital, the fund management company that has extensive experience in investing and building technology-focused companies. This is the important thing. The founders of BOV Capital have been instrumental in developing the Sri Lankan entrepreneur ecosystem over the past 7 years. The Dialogue Exit and Innovation Fund is now many revenues created by Dialogue to enable aspiring the entrepreneurs and promising businesses to grow. Make the Sri Lanka import 7 years before it has been applied. Okay. Other initiatives include Idea Mart and Idea Biz platforms, which supports over 8,000 entrepreneurs. And I say, do a service creation in an environment where services can be constructed across 3 domains, namely telecommunication, internet, and connected services. It's the growing industry in the world. So Dialogue is now helping to do Sri Lanka. dialogue partnership which incubator, hubs, and awareness programs will collectively contribute towards the holistic vision to accelerate digital startups and innovation opportunities in Sri Lanka for high-tech entrepreneurs. Right? IdeaMart and IdeaBiz platforms. 8,000 entrepreneurs, island-wide. What are domains? Telecommunication, internet and connected devices in Sri Lanka. Private sector organization have created this venture capital finance. Okay, so this will, I think, give an eye opener for us. Still, we bankers, not come out from the cages, come out from the boxes. Still, we have not developed innovative products. Although we have not followed up the innovative products created by other world organizations, companies. So it is high time. Because today is a big market for that. Today is a very big market. Most of these SMEs, small entrepreneurs, are, to look at, needed this type of support. Let us see what happened to the enterprise Sri Lanka. There are 11 projects has been introduced by that government. Again, we can take up still. අපේ බැංකුවල ක්‍රියාත්මක කරන්න පුළුවන් with our capacity, not depending on the government or the central bank refinance schemes. If you go for loan, you need refinance. You go for loan, traditional way of giving granting facilities, you can't do that. Why? You have to be within the framework, you have to do. Out of the framework, you can't do it. You are stuck in between. So we have to innovate something. New ways of breaking out and coming out and do something. These are the state banks can do this. Only private banks. Because they can take up the risk and develop a system. Only one thing is, first, can you give the idea what is the venture capital financing, what are the benefits, what are the shortcomings. If anybody needs a short-term return investment, venture capital is not an instrument for investment. There are number of what do you call it, the angel VCs. Those who have funds insufficient or surplus funds with them. They don't know what to do with their funds. So we can offer them a long-term plan. So 5 to 7 years to get their returns if they're interested, not immediately. And that return would be much, much, much greater than investing in the bank and getting an interest. So bank can be as that company which have been started subsidiary. Indian scenario I gave you, they start a subsidiary, and after developing the company, that company will be separate, created as a separate entity, technology development. So there's no way saying that no, it is there, can do. Okay, when I'm having tea in the here in the downstairs, a certain banking officials from the central bank, right? they have given a certain clue for us, for our thoughts. Now the government required 1 trillion. Government is trying to borrow from the banking sector 1 trillion rupees. 1 trillion rupees. We just discussed how I'm going to operate this. So, if it's going as a loan, individual bank cannot enter in that facility. So the banks has to make a consortium, syndicate loan to the government. Syndicate loan to the government. Because you see, the government is with this money, all the banks has to get together and create a product to fulfill this. Then normally what will happen, what is happening, government creating bonds, issuing median to 5-year or 10-year bonds and selling to the banks. Banks are asked to purchase those bonds and the bank's liquidity is taken out by the government way of selling bonds to the banks. Now the problem is these bonds are long-term. The benefits are getting on maturity. Say 5 years, after 5 years. During this period, what will happen to the bank? Bank has to face a liquidity crisis because there's no income generating from that funds given to the government. So therefore, liquidity crisis can be expected within this scenario. So it's a crisis situation. Okay, so now we had to alert as bankers. Now you are following this advanced diploma in credit. These products are mostly, what we discussed today, are mostly for high net worth, high big customers, corporate customers. If you look at your portfolio for the last 3 years, how many customers you have offered these corporate types of facilities? Not more than that. 2020 Central Bank report. So it had 21 Central Bank reports. It says the bank lending, right? Lending portfolio growth has been declined by 9% during that year. On Central Bank report, the banking sector advance growth, loan growth has been declined by 9%. What does it mean? What does it mean? There's no demand for lending. There's no borrowers. Borrowers are lacking. 2020 report value, the new loans has been granted. New loans has been granted, although growth has been declined, and the NPA levels increase more or less same in the industry. These are eye openers for us. We are driving for. So we had to specifically branch managers in the branches. We had to look, come out from your cubicles and go for market-oriented schemes for our survival, future survival. Okay, so those are the products that we have discussed today. 2 products I have discussed. Next week, another 2 products I'll be discussing. All those are in the corporate market lending. And I'm not touching on the non-banking or what you call disintermediation instruments, right? Only the banking instrument I'm discussing in your focus, because what are the other lending instruments, right? So those are not banking lending instruments. Certain instruments are there. Those are not banking. That is financial disintermediation products. Okay, right. So let us discuss those 2 next week. And this is what are the lending products other than the normal lending products available for us for corporate lending. Okay, thank you very much. So we'll meet next week. Any questions?